Hello, and welcome to today's webinar, How to Determine the Price of an Associate Buy-In, presented by Praxis. Today we will analyze the determining factors of the purchase price for an associate buy-in. First, we will look at the circumstances under which sellers should and should not discount or credit the sales price. Also, the circumstances under which buyers should and should not receive a discount or credit towards the sales price. Next, we will examine the size of the discount, and finally, how to determine the practice's value. Here today to share his expertise is Praxis Senior Advisor Roger Lee. Over the past 27 years, Roger has personally brokered the sale of over 500 practices and has served as an expert witness in the valuation of veterinary practices. At Praxis, he is in charge of assisting his clients through all phases of the transition.
Thanks, Max, and thanks to all our attendees. Most practice owners do not think they are hiring their eventual successor when they hire an associate. Most associates do not believe that they will eventually buy the practice that they are associated with. Therefore, associate contracts that specify a method for a buy-in at a later date are practically non-existent. So both the associate and the owner continue their agreement until one day the associate wants to buy and the owner wants to sell. This is how most associate buy-ins happen. But most associates do not want to buy what they helped grow. It is sometimes difficult to retroactively calculate the contribution the associate has made to the practice and discount an amount for the purchase price. For example, an associate joined a practice worth $1 million, and over the next 5 years, the practice grew from $1 million to $2 million. The owner decides that it is time to sell, and the associate decides that they would like to buy the practice. The owner says, "I'm prepared to sell the practice for $2 million. The associate says, "The practice was doing $1 million the day I arrived, and you were operating at capacity. I added that extra $1 million. The owner, on the other hand, says, "Those were my patients you treated in my facility, utilizing my staff and my supplies, and you were paid well for your work. That is my extra $1 million. What you have here is $100,000 in legal fees. Obviously, it is important to properly take into account all factors when structuring an associate buy-in." The associate almost always has the perception that they helped build the practice and increased its value as a result of their production. As a result, it is standard for the associate to feel that they should not have to pay more money to buy into the practice as a result of increased production for which they were responsible. The question is whether an associate who has worked in the practice for several years should pay the same price as any other buyer or be given some special consideration for their relationship with the practice and the patients. The primary method for pricing a practice for an associate buy-in are fair market value, a discount, or credit. Fair market value would be established by an independent appraiser and determined by the utilization of a capitalization rate or a market comparable method. In other circumstances, owners can discount the purchase price based on the years of association. For example, an owner may discount the price of a practice a certain percent for every year that the associate has been associated with the practice. Finally, one can apply a credit toward the fair market value purchase price. Equity credit is similar to the old phrase sweat equity. The owner of the practice may take the growth of the practice into account and give the prospective buyer a certain percentage of that growth as a credit toward the fair market value price of the practice. The question always becomes, why would the owner of the practice even consider discounting the price or granting equity credit? The reason is because the owner may have profited handsomely from the association and earnings of the associate over the years. When the associate adds additional revenue to the practice, the only expenses associated with that additional revenue should be the compensation of the associate and the production-related cost. Another reason the owner of the practice might consider a discount is the possibility of the associate opening their own practice nearby instead of buying in. The associate could take, for example, half of the practice with them, which would drive down income and drive up overhead. Also, any prospective buyer considering the acquisition of your practice would be extremely concerned that the remaining patients you have in your practice would know the name of the associate and might prefer the associate rather than the new owner. In other words, if the associate moves down the street and takes a good bit of your practice with them, it is going to make it extremely difficult to sell the remainder. If the associate had signed a non-compete, this scenario is very unlikely. A key factor in determining the associate's discount is not only whether the practice grew, but why it grew. It is much less likely that the associate would get a large discount if the practice had more than enough patients for both the owner and the associate, or the associate had been extremely well paid for his work. Under those circumstances, the owner may feel that the associate was merely taking advantage of untapped business that was already available in the practice. In that case, the owner might feel that little or no earned equity credit or discount should be provided. Conversely, if the associate had to go out into the community and build relationships in order to add clients and patients to the practice, or perform procedures that the owner could not or would not perform, thus adding revenue to the practice, there is a much stronger likelihood that a larger discount in the purchase price should be offered. In circumstances where the associate is merely capitalizing on the current client base and not building it, the practice should be valued based on its present value at the time the associate buys in. However, if the associate actively grows the patient base, then the practice should be valued at its past value as of the date the associate joined the practice. Whether you use the past collection or your present collection as a valuation method depends upon how the growth was obtained. Whether the price should be set as the past value or the present value is often a matter of perspective. Whether there's a discount or a credit for the determination of the purchase price, and the size of that discount or credit can be difficult to determine without a historical reference. Bringing objectivity to the discussion often requires neutral and knowledgeable third-party advice. We render that advice often. If we can be of service to you in your associate buy-in, please let us know.